Good morning, everybody, and welcome to the New York SBDC's webinar series. I'm Kathy Fitzmaurice from the central office, and I'll be your host for today's webinar on personal credit. Your microphones and telephones are currently muted to eliminate background noise during the program. We will take questions throughout the presentation. To ask a question, please type it into the question box on your control panel, or if you have a working microphone, you can raise your hand by clicking on the hand icon and I'll unmute you. Or if you've self-muted, you can just unmute and ask away. Today's program is being recorded and will be available through WebMQS in the Shared Resources section. And I want to thank our Canton SBDC for arranging this webinar. So let's go ahead and get started. I'm pleased to introduce Jerry Manor, Communication and Business Development Coordinator from SeaComm Federal Credit Union in Massena, New York. Welcome, Jerry.
Well, thank you very much, Kathy. I appreciate the opportunity to speak to your folks.
Oh, we're glad to have you.
Thank you. So we ready to go?
We're ready to go. You can take it away.
All right, thanks very much. And first of all, hello, everybody. Certainly glad to have you aboard for today's webinar. We're going to talk about personal credit, very important topic, and as business advisors, many of you do know how important that is, but it really affects a lot of aspects of folks' lives, and we'll get into some of those and talk about some things people can do to improve, things like that. As Kathy said, anytime if you have a question, please don't hesitate to ask. My presentations, I don't wait till the end to say, oh, does anybody have any questions, because by then we've probably all forgotten them. So don't hesitate to ask at any time. Not guaranteeing I can give you an answer, but I'll do the best I can. Anyway, a little bit about me before we start. I work at SeaComm. We are a credit union based in Massena, New York, right up there on the Canadian border in northern New York. And I'm just looking out my window right now. We have a little light snow falling, but at least it's not 18 below zero like it was the other day. I think we're at about 20 degrees today, so much, much nicer. And we've been around since 1963. Our credit union started here in Massena at the General Motors plant, when there was a General Motors plant in Massena. As you probably know, it closed several years ago. Fortunately for us, we have diversified a little bit. If you don't know this, credit unions are financial cooperatives, so it's a membership organization, and all the members have to have a common bond. So our common bond at the time was you were a unionized employee at the GM plant or a family member. We extended that to all employees at the plant, then we added other companies. But in 2000, we became what's called a community chartered credit union. And what that means is anybody in the community can be a member. Our community is all of St. Lawrence County. Now, for those of you unfamiliar with St. Lawrence County, it's the largest county in the state in area, but one of the smallest in population. We also have a little bit of Franklin County, which is the county to our east, and our total population base is about 150,000 people. And I used to be a radio guy. We used to joke on the air that we have more cows than people up here, and that may or may not be true. But anyway, we have about 40,500 members of the 150,000 folks. And so we've grown from the 10 guys at GM who started this credit union. And we also have locations in Potsdam, in Canton, which is where the SBDC up here is, and we're also in Ogdensburg and over in Franklin County in Malone. But now let's talk a little bit about personal credit. And of course, with personal credit comes a credit report. So what exactly is a credit report? Well, a credit report's an accumulation of information, all kinds of information about people. And the funny thing is, most people may not have a lot on their credit report, but a lot of folks do have a credit report. Basically talks about how you pay your bills. You know, it talks about what monthly debts, all kinds of information. And we as lenders use the credit report to decide whether a consumer is a good credit risk or a bad credit risk. And again, it happens not only with personal loans and mortgages, car loans, that type of thing, but also with small businesses. And I know that when a small business comes to us looking for, you know, what we call an MBL, a member business loan, we take a look at their personal credit, obviously. And that's why it's important for your clients to know what's on their credit report. and be familiar with what exactly is on it, what they can do to make it better. So again, if you guys get familiar with it, then you can help them be familiar with it. So some of the information you're going to find in a credit report. Well, of course, identifying information. They're going to see their name or names, because some people use different names. My name is Jerry Manor, but my birth name was Jerome. So if you look at my credit report, not only will you see Jerome Manor, you'll also see Jerry Manor, because that's how I'm known. So depending, people get married, things like that, names change. So that information is going to be on your credit report. Of course, your address and addresses, where you live now, where you lived last year, where you lived 5 years ago, that information is there. Social Security number, obviously, telephone number, things like that. That is the kind of information you're going to find on a credit report. And then, of course, very importantly, your credit history. In other words, how you pay your bills. Your bill paying history with banks and credit unions. If you have a store card, those credit cards that stores like to give you when you're shopping, especially at Christmas time, they'll tell you, oh, you get 15% off if you sign up for our credit card. Well, that's on there. Finance companies, if you borrow money through them, that's going to show up on your credit report. And this is the bad one, public record information. So if you don't pay your bills and somebody files a judgment against you, that's going to show up at your credit report, or I should say on your credit report, tax liens, bankruptcies, all that kind of bad stuff. And that's what really can hurt a person. But, the thing about credit reports that's kind of cool is time heals all wounds. So as time goes on, the bad information becomes less and less important. But nonetheless, it's very important when it happens and for a period of time. So the public record information, that bad stuff, can really hurt a person's credit report. Now, report inquiries, and this is the one that people wonder about. There's a lot of misconceptions out there, and we'll cover some of them later in the presentation. But, when somebody requests your report, that shows up on your report. So for those of you who have seen your credit report, you can see who has been looking at your credit report. So report inquiries on your credit report. Credit grantors who have received a copy of your report, that shows up on your credit report. And that's a good place to look for identity theft. If somebody say you did not apply for credit, and you see on your report that people have been looking at your credit, then maybe somebody has gotten your information. So that's why it's really a good idea to check your credit report periodically, because that can definitely help you if you're a victim of identity theft. And of course, dispute statements will appear. So if you look at your credit report and you find a mistake, and believe me, the chances are you might find a mistake, because the most recent statistic I saw was 25% of credit reports have mistakes on them. That's 1 in 5. And then I saw somebody else who said it's more like 30%. Whether it's 25 or 30 doesn't matter, but the point is that a lot of these reports have mistakes on them. Another excellent reason to take a look at your reports every once in a while. So again, lots of information about you, about your credit history, if there's any public information out there about you, and the report inquiries and dispute statements, all the things you'll find on a credit report. Okay, so now you might be wondering, where does all this information come from? Well, first of all, it comes directly from the creditors. So say if you come into SeaComm and you want to take out a loan, we are going to pull your credit report. If you go to a car dealer looking for a car, they're going to want to finance you, so they're going to pull your credit report. You might go into a furniture store and they have that 2 years interest-free deal. You might want to try to get that. They're going to pull your credit report. The thing is, you have to give them permission. But in a lot of cases, when you sign up for something, somewhere in the small print it says, we have permission to pull your credit report. So, creditors, any kind of a creditor looking to offer you credit is probably going to pull your credit report and then report back if you don't pay. They'll also, in certain instances, report your good payment history. And that mostly comes from banks, credit unions, finance companies, and so on. If you make your payments on time, that's going to show up in your report. What also will show up is if you're late at all. And what do I mean by late when it comes to credit report purposes? Well, that's 30 days delinquent. Now, a lot of people think that, if you miss a payment by 3 or 4 days, we're automatically going to report that to the credit bureau. That's not really the case. In most cases, you have to be 30 days late before you go to the credit bureau and report it as delinquent. But here's the deal, and this is something you should really cover with the people who you help. Yeah, even though it doesn't matter if it's up until 30 days delinquent, often cases there is a late fee, and that's what you want to stay away from, because it's money that should stay in your pocket, not in somebody else's. So anytime somebody takes out a loan or some kind of an obligation, they should know what all the details are. In other words, is there a grace period? How many days is that before I have to pay a fee? And again, those are all bits of information that everybody should know. Okay, now all these bits of information coming from banks and credit unions, they direct them all to the credit reporting agency. Now here's the situation. As you probably are aware, there are 3 that we'll cover in a minute, but not every creditor reports to all 3 credit bureaus. For instance, XYZ Bank might only report to Equifax. They may not report to TransUnion and Experian. So that's why when you're looking at the credit report, you should definitely check all 3. Now, the credit reports are calculated monthly, so that's why they can change quite a lot, and that's why people want to take a look at them as frequently as they can, because things can change rather rapidly. And not everything changes, but it seems to me that the bad information goes on a lot quicker than the good information. But again, your credit report is calculated monthly. So I mentioned the 3 credit bureaus. Here they are. There's Experian. Experian, they work for both consumers and businesses, and basically they provide creditors and many other people with information they can use to make business decisions. That's Experian. They were also the first to offer access to the credit report online. That's made it much easier for consumers to get their credit reports and take a look at them, the online access. Equifax is the next one. They have both individual and business solutions, and they offer a credit watch service. So you can actually, you have to pay for it obviously, but you can get put on their credit watch service and they'll send you alerts and things like that. TransUnion, they're another one. They provide business intelligence service and credit decision making, and they also have fraud prevention tools. So those are the 3 credit bureaus, the 3 national credit agencies. Now there are local credit agencies that some financial institutions use, but pretty much it's the big 3 that are most important. And again, as I said before, very, very important when you're checking, or some of your people you're helping are checking their credit reports, they need to check all 3, because not every creditor reports to all 3. Some only report to 1. And I know in certain instances, we normally pull one particular credit report, but sometimes we have to pull another one if their creditors are not reporting to that one. So again, it's important to check all 3. Anybody having trouble hearing me? I got a little sign that popped up saying there was network connection problems. Are we okay?
You're sounding good.
Oh, okay. Thanks. I don't know why that popped up. Okay. Now, to get a credit report, you folks have probably all seen this website. I hope you have anyway. annualcreditreport.com. That is the government-sponsored website where consumers can get all 3 of their reports once a year free of charge. Again, annualcreditreport.com at the bottom of your screen there. And it's a very simple process, actually. For those of you who have not done it, I would highly recommend that you do it. Now, there's also a phone number you can call if you'd like to get your free report by the phone. They'll mail it to you. And let me see here. I've got it right here. I didn't put it on the presentation, but it's 877-322-8255. 8228. And according to the folks at the credit bureaus, if you do call that number, they will mail you your credit report within 50 days, or 15 days, not 50, 15 days. So again, if you want it by mail, you can get it 877-322-8228. But it is much easier to get it at annualcreditreport.com. Basically what happens is you get on that website, it'll direct you to each of the three, Experian, Equifax, and TransUnion, and you go and they ask you a few questions to establish your identity. They may say, okay, where did you live at, or where did you live in 2006, things like that, questions that you can answer. And then you can download your report. You can print it out, you can save it, you can take a look at it, and it gives you an opportunity to make sure that it's absolutely accurate. Now when you look at your report, if you find it's not accurate, then what you have to do is actually dispute things, and there's a big process we'll talk about in a moment. Okay, we've talked about the credit report. What people really talk about is the credit score, and that's different. And that website I just went to, annualcreditreport.com, that does not give you your credit score. Your credit score costs money. The folks who came up with the algorithm to determine the credit score, how they come from all the linear information in your credit report to a number, it's a company called Fair Isaac and Company, and they get their pound of flesh every time somebody gets their score. So the score's not free unless you go to one of those sites like Credit Karma or Credit.com. They give you a score for free, but it's not your FICO score. We'll get into that as well in just a minute. So your credit score, it's the number that comes from your credit report. And this number outlines borrowing, charging, and repayment activities. So all that information we saw on the credit report is somehow converted into a number by this algorithm developed by Fair Isaac and Company. Now it's based on that formula. It's called your FICO score because of Fair Isaac and Company. That's how they came up with the name FICO. And again, that formula is a state secret, or at least it's not very well known because, you know, basically they make money on it and it's very proprietary. Again, a three-digit number, the higher the number is, the better your credit score is. Okay? That's how it works. Higher, better, lower, worse. So here's where the rubber meets the road. And this is the part that some folks don't really understand as to how it works. What makes up the score? Now, I said the formula is secret. It is. But we have a general idea of how it works. So number one, most important part, 35% of your credit score is basically based on payment history, how you pay your bills. As I mentioned before, when you look at a credit report, you're going to see different credit lines, we call them, or trade lines, and you're going to see, okay, you know, one time 30 days delinquent, one time 60 days delinquent, one time 90 days delinquent. Each delinquency causes the numbers to drop in the credit score. And if you see the columns all paid as agreed, that means you've always paid on time, and that helps your credit score. But 35% of the score is made up of payment history. Now that's the good thing. Also part of that 35% is the bad stuff. We talked about legal before. So say if you don't pay a car loan, what happens? Well, eventually the car is repossessed. There's some legal there, and it'll show up on your credit report. If you don't pay a hospital bill, what happens? They send it to a collection agency. Collection agencies show up on the credit report and hurt your credit score. Anytime you don't pay on time, it hurts. You don't pay your phone bill, they'll eventually send it to a collection agency, and that will show up on your credit report. So all that bad stuff when it comes to payments shows up on your credit report. Not all the good stuff does, and that can be a problem. Say you've got, I'm just going to pick a phone company out of the air, Verizon. A lot of people have Verizon. Now you could be a Verizon customer for 20 years and always pay your bill on time until you run into a problem. Maybe you lost a job or something. You stop paying, they send it to a collection. You don't get any credit for all the good payments you made, but you do get demerits and a loss in score for the collection. So again, with utilities, things like that, you really don't get any good credit, but you can get bad credit if you don't pay, if it's sent to a collection agency. And here's a little thing for you. People often say, well, what's normally causes the most problem? And what we've found is it's medical bills. People who don't pay their medical bills, usually the hospitals, doctors, clinics, and so on, wait 0 time to send it to a collection agency. Obviously, they want to get the debt off their books, so they sell it, oftentimes for pennies on the dollar. But every time something goes to a collection agency, that shows up on the consumer's credit report, and it hurts their score, and it hurts it badly. And here's something else. The higher your score is, the more one bad thing can hurt it. Okay? So that's something to keep in mind, too. 30% is something called capacity. Another way to put this is credit utilization. And this, of course, 30%, pretty important part of your credit score. Basically, that has to do with credit cards. And I explain it like this. Say you have a credit card with a $5,000 line, and you've got $4,999 on that credit card. In other words, it's maxed out. You have 0 capacity. That hurts your credit score. It hurts it a lot. So credit utilization or capacity is very, very important. And again, I don't know about some of you, but some people I know, myself included, I like to use my credit card for everything because I enjoy those rewards. So basically, I've got all my bills coming out of my credit card. I've got everything I buy, groceries, gas, whatever, all coming out of my credit card. And the way my budget works, I budget everything so when the bill comes due, I make the payment. And I don't accrue any interest, but every once in a while, my credit card balance gets a little bit high because everything's on there. What I have to do is make sure that I have enough room. Now, rule of thumb is you should never be more than 30%. Some people say 25%. So in other words, if you have a $1,000 line, you should never have more than $250 on that credit card. Now, if you have more than one credit card, it's cumulative. And if you're a person who likes to use a credit card, then you should have enough credit line. So more than one credit card, even if you don't use it, that's good, so that you have enough that you don't go over 25 to 30% of what your credit line is. So that's 30% of the score. Capacity or credit utilization, very, very important. Next is length of credit. In other words, if you're an old guy like me, you're in good shape because I've been borrowing money since the 70s. So people can look back on my credit history for a long time and see that I'm borrowing and how I've done it. Whereas somebody just getting into the game, they're brand new. That hurts 15% of their score, so that hurts. So again, length of credit. And that's why it's a good idea never to close an old credit card, because if you've had it for a while, it can show your credit history, even if you don't use it. The thing is, number one, if it's got a fee, then yeah, definitely close it. But if it doesn't have a fee, even if you're not using it, you should keep it. But here's a tip. If you don't use it at all, you should at least use it once every few months. Charge a tank of gas or something just to keep it open. Because sometimes what happens, these credit card companies get sick of somebody having their card not using it, cost them to maintain it, so they will close it. So again, you should use it once in a while if you want to keep that card for the capacity.
Jerry,
yeah.
We had a question come in. You sort of addressed it. Does it hurt your capacity if you have a bunch of credit cards open but never use it? Are you better off just having 1 or 2 open?
No, you should have more than 1 or 2. Here's the reason. Again, it's capacity. Now, don't be ridiculous about it. If you have 25 or 30 credit cards, that's a little too much. And what happens, the lender will look at that and say, well, this person could get into trouble with all those credit cards. What's the ideal number? I don't know. With the credit card rewards programs that are available now, 5 or 6 I don't think is a bad thing, or even a little more than that, because some credit cards are better for certain types of purchases if you like the cash back. So again, the key to all of this, obviously, though, is discipline. Because if you have a credit card and you run a balance and pay the interest, then that wipes out any rewards you get. So again, keep that in mind. But certainly, if you have 5 or 6 credit cards open, that's not a bad thing at all, because that adds to your capacity. So say, for instance, you decide you're going on vacation this spring, and who wouldn't want to after the winter we've been through so far? But you're going maybe to Europe or going to Cancun or somewhere where it's nice, and you're going to spend some money. Let's face it, vacations cost money, and it's always smart when you travel to use a credit card. And this isn't on the presentation today, but I'm just going to go do a little aside here. Credit versus debit cards. Credit cards are always better to use when you're traveling for a couple of reasons. Number one, the security protections on credit cards much better than debit cards. Okay, a debit card, you can be out the money, and even if they do make good on it, it may take you a while to get your money. Because remember, if your debit card is compromised, they're in your account. Whereas a credit card, they're only in your line of credit. So again, if you're traveling using your credit card, that is the way to go. Debit cards, not so good traveling. Okay, but anyway, so you're going to travel, you're going to spend a lot of money, have a great time. Obviously, you are a smart consumer. You've got that money in your savings account ready to go, pay it off when it gets back. But what happens is, while you're out there spending all that money, if they happen to do your credit report at that particular time, it's going to show, a lot of utilization. So you want to have enough credit line to cover that so you don't go over 20, 25, 30% of your capacity. Okay, does that answer the question?
I think so.
Okay. If anybody has a question at any time, don't hesitate to chime in, and I'll answer it to the best of my ability. So we just talked about length of credit. Old guy like me, they can look back a long way. Creditors can see how I've used credit, since the 70s. It's good for me, helps my credit score. 10% recent debt accumulation. So here's the deal. If you're running all over town applying for debt, applying for loans, I should say, or acquiring debt, or maybe signing up for 5 or 6 different credit cards all at the same time, that is going to hurt your credit score. Because what it shows is maybe a little desperation. Now, it doesn't mean that you shouldn't apply for credit cards, because I'll tell you what, there's some great deals out there and some great cashback cards and points cards. But, you shouldn't apply for 6 or 7 of them at the same time, because if you accumulate a lot of debt, and I'm not talking about money-wise, because say if you're taking out a mortgage, you're going to accumulate a lot of debt, but it's one loan. But if you're getting a bunch of loans all at the same time, that's going to hurt your credit score. So again, they look at opening dates and the number of inquiries. Now, inquiries, as I said before, when somebody takes a look at your credit report because you're applying for credit. But an inquiry is also when you take a look at your credit report, and we'll talk about that in just a minute. Now, the final 10% of your credit score is mix of credit. So what I mean by that is the mix of installment versus revolving debt. And I'm sure all of you know installment versus revolving, but just for a quick refresher, installment debt's like a car loan where you borrow X number of dollars, you pay it off in installments, a mortgage the same way, personal loan, things like that. Revolving debt is like a credit card. In other words, you can go out and spend money with your credit card, pay part of it off, and continue to revolve the debt. Now, your credit report likes a mix. It likes to see you using both kinds of credit, but it likes installment credit better than revolving credit. So in other words, you've got a mortgage balance of $100,000, that's fine. If you have a credit card with a balance of $100,000, not so fine. So again, installment better, revolving not so good. But revolving is necessary to have a good credit report because you still have to show you can use revolving debt wisely. So again, it goes back to capacity. Don't max out those cards. You can max out one if you have enough other cards to cover that, not up to more than 25, 30% of your available balance. Here's another one people may not know, finance companies. You go with a finance company, that is going to hurt your credit report because chances are that means you're subprime and you've had problems. So again, you can steer your clients away from finance companies. They're just not good for your credit report. So now let's cover who looks at a credit report. Well, obviously, the Fair Credit Reporting, or maybe not so obviously, the Fair Credit Reporting Act gives people who have, quote, a permissible reason, whatever that means. Actually, creditors who are considering granting you credit. So again, if you come into the credit union or a bank and are looking for any kind of a loan or a credit card or any kind of credit, we're going to pull your report. But a lot of other people check your credit as well. Employers, many employers look at a credit report before considering a person for employment, especially in our industry. You know, for obvious reasons, we don't want somebody who's in financial difficulties working for us. But there's a lot of other types of companies that look at credit reports before they'll hire somebody. Here's another one that's very important, insurers. You know, if you get car insurance, if you have a good credit score, your car insurance premiums are less than if you have a bad credit score. So again, that's something that a lot of people don't know, but that's very important. And of course, they look at your report to determine whether they're going to give you an insurance policy. So that's another reason why you want to, keep your credit report polished up. Government agencies, they look at credit reports as well. And, again, permissible reason, anybody with a legitimate business need for the information. Landlords, especially landlords of big complexes, they'll look at a credit report because, let's face it, they are extending credit in a way. They're allowing somebody to live in their property and pay in installments. As I said, insurance companies, a lot of utilities will look at credit reports as well because they'll decide from the credit report whether they will give you the service with a deposit or without a deposit. With somebody who has a good credit score, they can get a cell phone from Verizon or AT&T or any of the big companies without any deposit. If a person goes in looking for a contract with bad credit, they'll have to pay a deposit. Some of those deposits are pretty large. So there's a lot of people out there looking at credit reports and credit scores. As I mentioned before, when you go out to look for a car, the dealership is going to want to pull your credit report because obviously they want you to go finance through them so they can make a little extra money on the deal. So they will want to pull your credit report as well. So lots and lots of people look at it. That's why it's important to, number one, know what's there. As I said before, you want to make sure it's accurate because 20 to 30% have mistakes, and you want to make sure that it's as good as it can be. Because figure this, over your life, if you have a bad credit report, it's going to cost you lots and lots of money. Because as you know, banks, credit unions, anybody who lends money normally prices the loan by credit score. So interpreting your credit reports, we talked about the inquiries. Now everybody who looks at your credit report, it's called an inquiry. Now a hard inquiry, that's the one that counts against you. So how much does it count against you? Well, depends on what your credit score is. I've heard people say, 2, 3, 4, 5 points. If you have a credit score of 800, 2, 3, 4, 5 points is not going to hurt you. But if you're in that borderline area, you don't want to have too many inquiries at any one time because it'll knock points off your score. So a hard inquiry knocks points off. Say you apply for a credit card. You're shopping for Christmas and you go to one of the department stores and they say, okay, we're going to give you 20% off if you apply for our credit card. Well, they're going to pull your report, and that's a hard inquiry, something to keep in mind. Now, I'm not saying you shouldn't take it out because it might be worth the 20%, but if you do it at 5 or 6 different stores, that's going to hurt your credit report. And again, it takes a little while for that to come back up where it should be. So again, keep that in mind. Now again, applying for a store card is not a bad thing, and it's not a bad thing to have them, but one thing you want to keep in mind, and again, pass this along to your clients, store credit cards, usually very high interest rates, very high. In fact, I just saw one that was 29.9%. That's just crazy, just stupid. So, the key with credit cards, as you all know, if you pay it off in full by the due date, you don't pay any interest. So if it's 30%, it doesn't matter as long as you pay the bill when it's due. Loan applications, when you apply for a loan, that is a hard inquiry. You come into SeaComm and say, I want to buy that car across the street. Okay, that's a hard inquiry. We're going to pull your credit report. Now, soft inquiries don't count against you. And this is where some of the confusion can arise. If you pull your credit report, that's a soft inquiry. You can pull your credit report as often as you like. Now, as I said before, the free annual report, you can pull it free once a year. If you pull it any other time, it's going to cost you, okay? But, pulling it yourself, you can do it as much as you want. It's not going to hurt your credit score. Now, a lot of times, you've probably noticed you'll get offers in the mail, credit card offers and whatnot. Basically, marketers, banks, credit unions, anybody who is issuing the offer, what they do is they go to the credit bureau and say, okay, we want everybody in XYZ area code or XYZ zip code with a credit score between X and Y, and we're going to make them an offer. That's how they determine who they're going to offer their credit cards to. That is a soft inquiry. Anytime it's for marketing purposes, to offer people loans, to do things like that, it's a soft inquiry. It does not count against you. And here's something that's fairly new. People used to be worried about, say, shopping for a car. As I said before, every dealership's going to want to pull your report. Well, now they've turned it to treating it a little bit differently. So in other words, if you're in a period of 2 weeks, go around to 5 or 6 different car dealerships, which you actually should when you're shopping for a car, they're all going to want to pull your report. That's all considered one inquiry. Okay, so it's not going to look like you're desperately applying for credit. It's considered one inquiry. The same applies when you're shopping for a mortgage. Obviously, it's a pretty big thing. When you're shopping for a mortgage, you should be looking around, shopping different financial institutions. Each one of them is going to pull your credit report. But if you do this all within the space of a month or so, it's all considered one inquiry. That's something to keep in mind. Now, the other thing is, if you're a victim of identity theft, or if you are turned down for a loan, you have the ability to see your credit report. And if you're a victim of ID theft, you can download your report for free and without it showing up on your credit score and your credit report. So again, if you're a victim of identity theft or you're turned down for a loan, you're allowed to look at it without anything going against you. So that's part of what's on the credit report. Open credit accounts, they still count toward total available credit, and that's why, going back to that question, that's why you want to have more than one, so that you can cover, if you use one, you have enough capacity. So again, they count towards your total available credit, even if you're not using them. And I like to keep a couple of credit cards. I only use them maybe once every 2 or 3 months to keep them open, but I very seldom use them. But it still counts toward my available credit, and the same thing works for consumers. Okay, missed payments. That shows up on your credit reports, and delinquencies, they will stay on your credit report for 7 years. 7 years. Charge-off, collection agency, all that stuff will show up on your credit report and stay there. Now, as time goes by, they become less important. They become less and less important. So in other words, a missed payment 6 years ago really doesn't have a lot of effect on your credit score. But a missed payment last month definitely does. Okay? Maxed out credit lines, as we said, scares lenders. It goes to capacity, 30% of your credit score. So again, one thing you can do is increase your credit line. Call your credit card company and ask them for an increase, or even open up another credit card. But again, that's an inquiry, so keep that in mind. And that's the thing, is you're juggling a bunch of balls in the air all at the same time, and all these different factors affect it. So you have to keep up with all these different things. So it's not as easy as people think it is. Debt in relation to income. Now, your income does not show up on your credit report. That's one of the pieces of information that's not there. However, your lender obviously is going to want to know your income, because let's face it, speaking from a credit union perspective, it does not do anybody any good to give somebody a loan they can't pay back. So income is important, and debt in relation to income is very, very important. So we always look at debt ratio. And I know that when you're doing business plans and so on, that's a very important part of it. But again, keep that in mind. So now, why is it important for consumers to have a copy of their credit report? Again, because of mistakes. As I mentioned, 25 and maybe as high as 30% of consumer credit reports have errors in them, mistakes in them, things that need to be fixed because it can have a negative effect. And as I mentioned before, you know, credit unions, banks, anybody who lends money prices loans on credit score. So in other words, if you've got, you know, a good credit score, you're going to pay the best rate. If you have a poor credit score, you probably still get the loan if all other things are good, but you're going to pay a lot more for it. So again, you want to make sure that credit report is accurate. When you look at your report, you can see where the problems are. Whereas if you just get a score, you really don't know, you know, where the problems are. You go in and apply for a loan, you get the loan, you ask your bank or credit, what was my score? They say, well, it's 740. You don't really know, you know, why it's 740. In order to figure out why, you have to actually look at the entire report. Also, it's a good idea to find out what accounts are open, because in a lot of cases, we have accounts we opened and forgot about. So looking at your credit report, or reports, as I said, there are 3 of them, you should look at all 3. You can find out what they have listed as open reports. And maybe some of that's incorrect information. To go back up to the first bullet, errors, you want to fix it. You also will have an opportunity to see what the creditors see. So you look at your report, you know what the bank or credit union is looking at. And for you folks who are speaking with somebody who's getting ready to open a small business, as I said before, we also look at their personal credit. And it's really nice to know going in, you know, that you've got good credit. And it's nice to know what you're dealing with. And also, if you're looking, and again, planning is so important with a small business, you know, you want to plan ahead. And if you know that you've got some little problems you can fix, well, that's all the better for you, because it's going to save you money in the long run. And as I mentioned before, identity theft shows up on your credit report. And that's a very, very important reason to take a look at it, because that's where it may show up first. Because if you see an account that was opened up that you never even knew about, chances are you've been a victim of identity theft, because that's what happens. You know, the crook will steal your information. And they steal it in a lot of different ways, and many of the identity thieves still work the old-fashioned way. What they'll do is they'll go through a purse and take a look at the Social Security number, name, and address, and just leave it. So the person who's been scammed has no way of knowing that they've been a victim. Then they use that information to open up accounts. They might open up a cell phone account, use the phone, you know, change the address. How easy is it to change an address? Just the postcard to the post office, and the bill goes, you know, somewhere, and the person whose name they opened the cell phone account in never even sees the bill. Eventually, of course, the phone company gets sick of not getting paid. They'll turn the phone off, so the crook throws it away and goes on to the next victim. In the meantime, you know, Ma Bell sends it to collection agency, and all of a sudden the collection shows up on your account. You didn't even know you had a phone. You know, that's the kind of thing that can happen. That's where it shows up on your credit report. So again, it's important, and we again recommend once a year, use the government website, annualcreditreport.com, download your report, look at it, make sure that it's accurate. So how do you fix errors? That's the process. Takes a lot of paperwork. You know, fixing errors, just like anything else, you've got to do a lot of paperwork in order to explain what's wrong. And again, what you do is you write down the information. Now, you send copies basically of everything. You know, you tell the credit reporting company, Equifax, TransUnion, Experian, whichever one it is, in writing what the information you think is inaccurate. Now, you also, you send copies, not originals, of the documents that support your position. So again, you have to give them some evidence that you're correct. But the really cool thing is they have 30 days to investigate your claim, okay? And they will leave that in your credit report, showing that you disputed the information that could be wrong. They must investigate, and of course, if it's a frivolous claim, then they might just drop it. But they will definitely investigate and let you know the outcome of that investigation. But the key is send all of this information in writing.
Jerry?
Obviously, yeah.
We have a question.
Okay.
If there is a sudden influx of cash and bills are paid during the same time frame, does this raise any red flags?
A sudden influx of cash, not necessarily. It depends on how it's, how much cash it is, how it's done. But as far as your credit report is concerned, no. Now, it may raise some questions at the bank or credit union. People who come in with a lot of cash, there's some procedures we go through, when cash is involved. But as far as a credit report, no, because the bills are being paid. But again, the non-payment issues stay on your report for 7 years, and they become less important. But say, okay, you're 30 days late or 60 days late, you come in with cash and pay those bills off. That's good for your credit report, but the information that you were late for 60 days or 30 days or whatnot will stay on your report for 7 years before it drops off. Okay?
Thank you, Jerry. And
okay.
I don't know if this is a comment someone else has made. Free reports once a year from each. Your thoughts about the 4-month cycle to ask for one company?
I'm glad you brought that up. I like that idea. And again, what it does is allows you to check it more frequently free, basically. Because what you're doing and what they're talking about is, say for instance, you request your Experian. That's the only one you request in January. Then you wait until March and you request your TransUnion. And then you wait until September or whatever and request the other one, Equifax. So what you're doing is you're looking at one of them every few months. So that actually gives you an opportunity to keep up with it a little bit better. Now you can sign up, say for instance, if you want to go to MyFICO, which is the FICO score, myfico.com, you can sign up and get your report from all 3 monthly. The problem is you have to pay for it. Everything has a cost with the exception of the annualcreditreports.com. But again, I love that idea of staggering it. Now granted, not everybody reports to every credit bureau, but a majority of creditors do report to each credit bureau. So again, if something bad happens, you'll find it out quicker. So that's a great idea, and thanks for bringing that up. Okay. So again, now, you had a problem, you protested it, you have to check your report again. Now, if it's identity theft, you get to check it for free. But I would say it's worth the investment. I think it costs, in order to get your credit report and a score, it probably costs about $20, $25. I haven't checked it lately, but it's somewhere in that ballpark. That is what it costs to get one report. But again, annualcreditreport.com, you get the report free of charge. That's the report in its entirety. However, you do not get the score. The scores are not free. You can buy your score, but again, that costs about $20. The score is not important per se. It's important, yes, for pricing your loan. But when you're looking at your report to say, look for errors, look for identity theft, the score is not what the important part is. Now, there are a couple of free services out there, which I mentioned before. One of them is called Credit Karma. I'll bet a lot of you have heard of that one because they advertise quite heavily. Well, when I do these presentations, before I tell anybody anything, I want to make sure I try it first. So I tried Credit Karma, and it's good. It's not bad. The thing is, you do not get your real credit score. You get something called a facsimile score or a Vantage score. It's not the credit score that banks and credit unions use. It's close. And again, usually it can go plus or minus 15 to 20 points. But what it does is give you a pretty good idea, and it's free, so you can set up alerts. And if anything major changes with your credit bureau, and I think Credit Karma uses Experian. I'm not positive of that, but they use one of the three. They'll send you a report. The other thing they do is once a month by email, they'll shoot you an email, say you haven't looked at it lately, and remind you to go and take a look at it. So again, it's not your actual credit report or credit score, but it's kind of a fun way to just keep an eye on it. There's a couple others out there. The other one I looked at is credit.com, and these sites also are pretty good because they have a lot of tools that will tell you things you can do to improve your score, and they have a lot of financial information out there. So if you're a person who likes to read that kind of thing, they're pretty nice sites, credit.com and creditkarma.com.
Jerry, we have another question.
Okay.
What is better for your credit, to delay a student loan payment or pay the balance at once?
Okay. Well, as far as your credit report is concerned, it doesn't really matter that much because here's the deal. As long as you're making your payments on time, that is good. You know, even if it's a student loan, and as long as you're paying as agreed. If you have to get a deferment or forbearance, obviously you're still paying as agreed. Now the problem with forbearance and those types of things is while you're not making payments, you're not paying off the loan, and interest is still accruing. So as far as for your own personal financial health, if you can pay it off, pay it off. But as far as hurting your credit score, it does not. And in fact, making payments on student loans can really help your credit score. And I can give you a personal example of that. When my daughter went to college, I got a credit card for her. And I work at a credit union, so I was the co-signer, which was nice because I could look at the credit card and make sure she didn't get in trouble with it. It was just a $250 limit, so again, obviously $250 can't get in too much trouble. But I told her, I said, please use it wisely. If you need to use it, try to pay it off in full so you don't pay any interest, but at least make the minimum payment. And of course, she also had to take out college loans. So she got out of college, started making her payments. She had made 2 or 3 on her college loans and had used the credit card wisely for the 4 years she was away. Well, she came in and had gotten a job and needed a car. So I said, well, go on into the lending office. If you need me to co-sign, I'll definitely do it. I know where you live. But she comes back 15 minutes later with a check in her hand. She didn't need me. Her credit score was 760 just by making her student loan payments and by using the credit card wisely. So again, to get good credit, you have to use credit. But again, with a student loan question, to save yourself money, if you can pay it off, definitely pay it off. But as far as, as long as you make the payments as agreed, whether the agreement is a forbearance or whatever, as long as you pay as agreed, it does not hurt you. It'll help your credit score. Okay? So, improving credit scores, and this actually is a great question to lead into this section of the presentation. So how do you improve your credit score or establish credit if you don't have it? Well, the first thing is, as I mentioned, a cosigner. Now, for those of you out here thinking about co-signing for somebody else, just keep in mind, if they don't make the payments, you're on the hook. So again, never co-sign for a loan you can't make the payments to, because if they don't, you will. And if you don't, it goes on your credit report. So co-signer can help somebody establish credit, though, or help somebody who doesn't have good credit, because the person who is co-signed for will get the rate of the co-signer. So they'll get a good rate even if they don't deserve the good rate because of their co-signer. Now here's a little known trick that I love. You can make somebody an authorized user on your credit card. Say you have a student or whatever. Make them an authorized user. The beauty of this strategy is you don't have to give them access to the account. So they can get credit for your good credit history and your good credit practices without actually having to do anything. So again, if you get somebody to put you as an authorized user and they have good credit, that'll help your credit report. Obviously, using credit cards is one of the easiest ways to establish credit. Now, in the old days, and some of you might remember this, college campuses during orientation, there would be tables with banks everywhere. Here's a free T-shirt if you sign up for our credit card. Well, they changed the laws. They don't allow that anymore. You cannot give somebody a credit card unless they have income. But it's a good way to start your credit out, because It's pretty easy to qualify for, say, a store credit card because normally they'll ask you what your income is, and they almost sometimes believe it without even checking. And they can go online and they can get basic information about you. But that's a good way, having a credit card. The key is using the credit card wisely and not getting in trouble, and of course that takes discipline. But using a credit card is a great way to establish credit. Another way is a secured loan or a secured credit card. Basically how that works is you deposit money in the bank or credit union, and then you take out a loan on that money. That is the collateral for the loan, and you pay, basically you're paying yourself back. And what that does is establish a payment record and then help your credit score improve. Same thing works with a secured credit card. We have a secured Visa here at SeaComm. Basically you deposit, I think, say if you want a $500 line, you deposit $700 in a savings account, and you use the Visa. It looks, works, talks, everything just like a normal Visa card. And if you use it as agreed for a year, it automatically converts into a regular Visa. But it's a great way to establish credit. So now I told you about some of the myths we're going to talk about, and we're almost out of time, so we'll go through these quickly. Number one, and I'm sure you've heard this from your clients, I have good credit. Of course, they really don't know, and you don't know without checking your report. That's why it's so very important to check your credit report. And this goes back to one of the questions asked earlier. Closing credit cards will improve my score. Actually, it can hurt your score, because if you decrease the capacity, your score can go down. So again, if you're not using a credit card, doesn't mean you necessarily should close it. Unless it has an annual fee, then you might consider closing it and opening one that doesn't have an annual fee. If you've got a credit card sitting out there you're not using that has an annual fee, you're wasting money. So, because there are plenty out there. Okay. Checking your report will reduce your score. Again, if you check it, that's a soft inquiry, doesn't affect your score at all. Income, nope, doesn't affect your score. It will affect your ability to get a loan, but it does not affect your score. Bad credit equals no loan? Not true. In a lot of cases, we offer loans to people who have horrible credit, but we take a look a little deeper because you want to see, why do they have horrible credit? Is it because of medical bills? Medical bills, if you have a bad medical situation, you can run up hundreds of thousands of dollars of bills in no time. Who could pay that back? So bad credit, we look at the reason. The problem is they're going to pay a lot more for the loan. For a car loan, if you have good credit, you might pay 2.5%. If you got bad credit, you're going to pay 18%. That's the difference. They may get the loan, but they're going to pay a lot more for it. That's why it's so important to maintain a good credit score. A lot of people think scores are locked in for 6 months. Nope, change every 30 days. Again, it's a really living document, your credit report. Changes frequently. Honest mistakes that can wreck a score. If you forget that you opened an account at Christmas time, used it, and don't pay it off, that'll hurt. Assuming automatic payments go through. Everybody loves automatic payments. You should check them out every once in a while. Make sure they're actually going through. Thinking a payment was made, but it wasn't. Again, keep track of your payments. Even if they're automatic, at least check your checking account. Make sure the money came out. Should do that once a month at least. If you miss a bill, obviously, you want to make sure you pay all your bills. And here's one that people run into too. Assuming your health insurance covers all your medical bills. Sometimes it doesn't. And as I said before, medical institutions are the quickest to report bad debt to a collection agency. So again, keep that in mind, and make sure that if there's a copayment, make sure the copayment gets paid. If part of the bill is not paid, make sure it gets paid. And that's it. And I think I made it.
Thank you, Jerry. That was great. I do have another question.
Sure.
How old do you have to be to get a credit card? When should you start to establish credit for your child?
That's a great question. And my opinion is, basically you're supposed to be 18 to get a credit card. But here at the credit union, we will actually offer credit cards, low-limit credit cards with a parent cosign to 16 and older. Obviously, you're not responsible for debt until you're 18, but it's a great idea to establish credit before that. The other thing to remember is there are identity theft schemes that take advantage of children. So sometimes a child can have bad credit without even ever having taken out any debt because somebody used their name in in an identity theft scheme. So it's a good idea, when your kids get a little bit older, run their name just to make sure that their report is not there or is good. And again, I think age 16 is a great time to start to establish credit, and the quickest, easiest way is with a credit card.
Great. Thank you very much, Jerry. Does anybody have any more questions?
One thing I like about doing these types of things in person is what I tell the participants. I love to have people share their personal stories. Obviously, it's hard to do in this format, but a lot of people have had a lot of different experiences, and it's fun to share them with the group. But anyway.
Well, thank you so much, Jerry, for taking time to present to us today. I really appreciate it. Oh, looks like we do have a question. How does a company or person report an incident to a credit card company? For example, property managers.
They have to set up an account with I'm assuming they meant the credit bureaus. They have to set up an account with them. What happens is they apply to, say, Experian or the TransUnion or Equifax that they want to set up an account. And the credit bureau has to do a little bit of investigating on their own, to determine that this person is legitimate. In other words, yes, they do have rental property that they are renting. So they'll do a little investigation, make sure, and then they'll give them a password or whatever to allow them to pull reports on people who want to rent there. So yeah, they have to apply for it. The same thing with any financial institution or anybody who wants to pull a credit report. They have to apply for the ability to do that.
All right. Does that answer your question, David? And does anybody have any other questions? All right, good. I think we're all set. So again, thank you, Jerry, very much. And
my pleasure. Enjoyed it.
Thank you, everybody, for joining us, and I hope you all have a great day. This ends our webinar.